August 2025. Question Question 2C. Question 2C. August 2025, question 2C. That's a question on time value of money. It's a question on time value of money. So just a minute. So
do we have here? First of all, the first item we have the transfer from the exchequer. Transfer from the exchequer, this is the amount of money which was allocated to this ministry from who? From the exchequer, or basically from the treasury. So remember here, we just need to have we can have two columns, maybe. Let's just have two columns. We have two columns here. And I hope you can see our figures up there. They are given in million of shillings. So we have the transfer from the exchequer. In other terms, I've referred to this as budgetary appropriation. This is basically the money which was allocated to this ministry from who? From the exchequer, or basically from the treasury. The transfer from the exchequer, that is 750. So below that, what do we have? We have the fees and licenses. So basically what I've said is that if we go to this ministry basically provides some services. It charges a small fee. So this is the fees, which basically is what is charged. And also what? Fees charged for the services offered. Fees and what? Licenses. That is still an item of revenue. So below that, we have liabilities. Liabilities for long-term benefits. Liabilities for long-term benefits. This is a non-current liability. We have the long-term borrowing, a non-current liability. Finance cost is an expense, is an expenditure. And then from there, we have the supplies and consumables used. I've said these are those items which are used in the office, like the stationaries and so on. That is an expenditure. Wages and salaries, an expenditure. Other operating, actually, we have other expenses. Other expenses, that is an expense. We have the transfer from other ministries. That is still a revenue. Transfer from other good, from other ministries. From other ministries. How much is that? Transfer from other ministries. I hope you can see that figure. Can you see that figure, Lydia? 𝐍𝐿, 𝐿𝐍, can you see that figure? 𝐿𝐿, can you see that figure? Transfer from other ministries. Is it 75? Yes, it is 75. Then we have transfer to other. Transfer to other ministries is an expenditure. Is an expenditure. Then we have computer equipment and software. Those are what? Assets. Yes. And then we have motor vehicle. Is also what? Is also a revenue. From what? From the exchange. From exchange transactions. From exchange transactions. How much is that? That is 150 million. That is 150 million. Then from there we have other revenue. So other revenue, so we also capture that here. Other revenue. Other revenue is an amount of how much? Is an amount of 900. Is an amount of 900. Then from there we have payables. Payables, what is this? Who can tell us what is a payable? From this category we have covered, we have covered in other topics. Payable is what? Meridian. 𝐍𝐿, 𝐿𝐍, 𝐿𝐿. What is a payable? A payable is what? A payable is what? I'm told by 𝐿𝐿 is the part of the creditors. 𝐿𝐿. 𝐿𝐍, these are an expense. 𝐿𝐍, this one is an expense. Hapana, this one is not an expense. Payable. Payable is a liability. Payable is a liability, is not an expense. That's that? Yes. In other terms, this is what we refer to as creditors in other topics. That's that? 𝐿𝐍, remember that. So reserves, this one will go to the statement of financial position. Cash and cash equivalent is an asset. Receivables is an asset. Inventory on consumables. Anytime you come across inventory, is a current asset. Is a current what? Asset. So basically, you can see we don't have any other item of revenue. So what we need to do, we get the total revenue. We get the total revenue. So that we move and we less what? The expenditures. But before we less the expenditures, give me the total assets. Not the total assets, the total revenue. Give me the total revenue here. The total revenue. The total revenue I'm given by Kezia a figure of 56, 56.25. 56.25, 56.25. 56.25, confirmed by Jeffa, yes. So then we need to proceed and we raise what? Expenditures. Expenditures, we have a number of them. I think we will start from where we have our first expenditure up there in those balances. The first expenditure we have should be the finance cost. Should be the finance cost. Should be the finance cost. And basically we record now the expenditures in the first column here. And that is an amount of 150. 150. Then we have what? We have the supplies and consumables used. The supplies and consumables used. So the supplies and consumables used, this one is an amount of 600. It's still an expenditure. So below that we have wages and salaries. Wages and who? And salaries. Wages and salaries, which is an amount of 1,500. So below that we have other expenses. Other expenses. Other expenses. So the other expenses is an amount of 1,800. 1,800, yes. So then from there we have transfer from other ministries. Remember that one was an income here or was a revenue. And then below that we have transfer to other. So this money transfer to other ministries. That one is considered to be an expenditure to our ministry here. Transfer to other ministries. Transfer to other ministries, how much is that? That is an amount of 750. Is that correct? The transfer to other ministries, is it transfer to other ministries? That one should be 750, yeah? Is that the position? 750? Jeff? Is it 750? Yes. So below that we have basically computer, motor vehicle land, all those are assets. Revenue from exchange, we have already considered that here as an income. Then we have other revenue, payable, reserves, accumulated fund, cash, reserve. Yes. So in our case, we don't have any other item of expenditure. So let's get to the total expenditures here. And basically we take that to the last column. We less that from our total revenue. We less that from our total revenue. You can see how simple this was because you just need to know what are incomes, what are revenues, what are expenditures. So this will give us a total of 48. We less it from that, and automatically in our case here, we will have a surplus. We will have a surplus for the year. 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 So the surplus for the year will be how much? The difference between those two values there. The surplus for the year, I'm told, is an amount of how much? The surplus for the year, I'm told here by Jeffa, is an amount of 825. 825. Kezia has also confirmed that. I hope you're getting the same Zido. I hope you're getting the same Meridian. Are you getting the same figure? Are you getting the same figure? Felix, are you getting the same figure? HP. Ni nani anajiita HP? Who is this? Is this Doris? Mwenye anajiita HP? Ama ni nani huyu? Yes, HP. Are you getting the same HP? Okay, sawa. That is confirmed. Yes. So basically, this is now what was required as far as that question is concerned. And basically, the marks allocated there were 5. So automatically, what is marked here are the items of revenue and the items of expenses. Oh, these Doris. Okay. So that basically what was required. So I want us to move now to the other part of that question. You can see how simple this is. Roman 2, the statement of financial position. Statement of financial position as at 30th of June 2025. As at 30th of June 2025, 30th of June 2025. Now, basically, I've said we prepare this one based on the accounting equation. We start by recording assets, we classify them into two, and then we less liability. So here we start by recording assets, and specifically, we start by recording the non-current assets. And I hope you can be able to recall, we say that the non-current assets, these are basically the assets which are expected to be used by an entity for a period beyond one financial year. Number two, these particular assets, they are acquired basically to help an entity in terms of doing what? In terms of generating income. In terms of generating what? Incomes or basically revenue. So therefore, those are the assets we start by recording here. So we have a number of non-current assets. We have a number of non-current assets. So which non-current asset do we have in our case here? So which non-current asset do we have here? I think we can start from where we have computer equipment and software. Can we go to where we have computer equipment and software? Can you see that, Doris? Computer equipment and software. Equipment and software. I hope you can be able to see that. Yes. So that basically is an amount of 400. 400. So below that, we have motor vehicles. We have motor vehicles. Motor vehicles having a value of 350. Then below that, we also have land and buildings. Land and buildings. Land and buildings. So for the land and buildings, that is an amount of 5250. 5250. Yes. So do we have any other non-current assets? Do we have any other long-term assets? I can't see any other. I can't see any other. I can't see any other. So what we need to do here is, first of all, we get the total. We get the total, so that then we proceed and record current assets. So this will give us a total of what? This will give us a total of what? This 7 and 9. Are you getting 59? The total non-current assets. Total non-current assets. Therefore, Felix, are you getting 59? Are you getting 59? 59, are you getting 59 here? 6,000. Oh, sorry, 6,000. Yeah, this one should be 6,000. 6,000. Then we proceed. We record the current assets. Now, for the current assets, we have this current number of them. Current assets, maybe you can start from where we have the first non-current assets. Is basically we have all of them below those balances. We can start from where we have the cash and cash equivalents. Cash and cash equivalent. Cash and cash equivalent. And maybe someone may ask here, what is cash? Cash refers to any money which is held in the bank account, including cash in hand. And the cash equivalent is our short-term investment. For example, if you have invested in things like what? The treasury bills, which are short-term, that is part of the cash equivalent. Or maybe you have invested in shares trading in the securities exchange market. That is not cash, but is a cash equivalent. You can be able to sell those shares within a very short period of time. So that is basically 750. So below that, we have receivables. Receivables, still this one is a current asset, and that is 300. And then we have inventory. Inventory for what? For consumables. Inventory for consumables is basically an amount of what? Is an amount of 150. All those are current assets. All those are current what? Assets. Do we have any other item of current assets? Any other item of current asset? Any other item of current asset? I can't see any. I can't see any. So what we need to do is basically we get the total current. Okay, in this case, I think we can just go ahead and let's get the total current asset first of all. Total current asset, this and this will come to 900, and that will give us 12. And then from there, we get the total assets. So how do we get the total assets? To get the total asset, we add the total non-current asset plus the total current asset. We add this and this. Total non-current asset and total current assets. I hope here you're getting 12. Are you getting 12? Yes, that is confirmed. So the total assets in our case will be what? Will be 72. And actually we can denote this using capital A. Our total assets will be capital A. And then from there, I've said, when preparing this statement of financial position for public sector entities, we proceed and we less the liabilities. So to this, we proceed and we record what? The liabilities. We record the liabilities. We record the liabilities. These liabilities, we classify them into two: non-current liabilities and what? And the current liabilities. Non-current liabilities and current what? Liabilities. Non-current liabilities and current liabilities. Non-current liabilities and current what? Liabilities. Non-current liabilities are the long-term liabilities. And I think we have two basically up there. The first item is transfer from exchequer fees and licenses. And then below that, we have liabilities for long-term benefits. That is a non-current liability. We have liabilities for what? For long-term benefits. For long-term what? Benefits, which is basically how much? 300. And then below that, we have long-term. We have long-term borrowing. So the long-term borrowing is an amount of how much? Is an amount of 1,500. So those are non-current liabilities. Do you have any other non-current liabilities? And I hope if you check on this particular question, you can see similar items are given together. I don't know whether you are seeing that pattern, because if you check, for example, these current assets, they were given together. The non-current liabilities were given together. If, for example, it is like expenses, they are given together. Yes, mostly if you check, you'll be able to see we don't have any other non-current liability. Maybe you can just go through the other items. So below that, we have finance costs, suppliers, wages, other expenses, transfer, computer, motor vehicle, land, revenue, other revenue, payable, reserves, accumulated fund, cash. You can see we don't have any other. So basically what we need to do here, let's get the total. The total. So this one would be 1,800. 18 what? 1,800. And then from there, we proceed and we record what? We record the current liabilities. So the current liabilities, I think in our case, we have, I think I've only seen one. The one, or basically the payable, that is. Other than payable, do we have anything else? I can't see any other. I think we only have one, and that is basically what? Payables. Payables. Who can see that amount? How much is that? The amount for payables? Kezia. And remember, you say that this one is a liability, not an expenditure. Kezia, I hope you can remember that. How much is that amount? Kezia, give us that amount. Give us that amount. Yes, I'm told by Kezia, this one will be 750. This one will be 750. Yes. And then what we need to do, because we only have one, we don't need to get the total current liabilities. We can proceed and we get the total liabilities. We get the total what? Liabilities. Total liabilities will be this plus this. And that basically will give us 2550. Will give us 2550. 25 what? 50 will give us 2550. 25 what? 50. So having that, then we proceed and we get something called the net assets. Net assets. And in fact, we can denote this using capital B. Total liabilities to be our capital B. So how do we compute the net assets? The net assets, this one is equal to total assets, whatever you have here, minus liabilities, minus total liabilities, what we have there. Net asset is equal to asset minus what? Liabilities. So we take 72 minus 2550. 72 minus 2550. That one will give us what? Notice. It will give us how much? Will give us how much? Will give us how much? 𝐍𝐷 will give us how much? Will give us how much? That one. It will give us 4650. So basically double underline that. We double underline that. So after double underline that, we finally record what? Equity. So basically I've said equity. This comprises of accumulated fund, which must be adjusted with the surplus or the deficit for the year plus the reserves. Plus what? The reserves. So the first item we record here is basically the accumulated fund. The accumulated fund. The accumulated fund, which we have there, which basically are given in those balances. I hope you can see accumulated fund is somewhere down there, below inventory, above receivables, and also above cash and cash equivalent. So accumulated fund is given as what? As 1125. That is the accumulated fund at what? At the start. So to this accumulated fund, we need to add the surplus for the year. We add the surplus. But remember, in this case, if, for example, we had a deficit, that one should be deducted. So we add the surplus for the year, and that is 825. So that now will give us the accumulated fund at the end. So this will be how much? So 0. Fine. That will give us 1950. Are you getting 1950? Are you getting 1950? The accumulated fund plus the surplus for the year, 1950. Yes, that is confirmed by 0. And finally, I'll say to this, we also add what? We also add the reserves. We also add the reserves. Now, we have reserves still above this accumulated fund, and the reserves is an amount of 27. And the reserves is an amount of what? 27. So we get now the total equity. And this basically equity is another name for net asset. Equity is another name for asset, simply because we know that from the accounting equation, we say asset are equal to equity plus what? Plus liabilities. So equity, for example, when we make equity the subject of the formula, you can see equity is equal to assets minus what? Liabilities. And actually, we are saying the difference between asset and liabilities, this one is also known as the net asset. So if you take asset minus liabilities as net asset, it can also be known as equity. So, yes. So equity is the same with what? The net asset. So the same case here. This total equity is the same with the net asset. It is the same with the net asset. So we add these two values here, which will give us 46 what? 50. 46. So, and basically we have said whatever you get here as our net asset, this one, that should always agree with that one. And I hope you can the case. So this basically what are located here were 5 marks. Okay, 5 marks. So this important. This one was a very, very simple one. Basically these were just a free word, 3 marks. I don't know whether this was a repetition, because we have another question, another similar question which was tested some time back. I want to give that other question as an assignment. In one of the most recent sittings, I think that question was just the same with this one. Let me see. So August of 2024. Yes. Actually, this question was just like a repetition. So I'll give this question here as an assignment. You'll be able to see the two questions are the same. This one I'll give it as an assignment. And basically this is the question for which sitting here. April 2024. Question number what? Question number 5A. Question 5A. Actually, the two questions are just the same. It's just like a copy paste. It's just like what? A copy paste, because I can see we have motor vehicles, but maybe automatically the values are not the same. Sawa? Yes. So what I want you to do, I want you to do this particular question here. I will see whether we are going to do it maybe in our next class. I think we can start with it because we also have other questions. But even before we meet, make sure first of all you attempt it on your own. It's a very simple area. It's a very, very simple area. This is an area whereby you should be able to get all the marks. If you come across a question from this area, you should be able to get all the marks. Sasa, yes. For today, I want us to stop at that point, and I hope those who did the exam for August have already gotten the results. Anyone who did the exam for August automatically got his no. Therefore, you did the exam for last city. I think yes. I hope you have gotten the results. Kezia, you did the exam for last city. Lydian, no. Zido, you did the exam for last city. Lydian, no. Felix, what about Felix? Okay. Okay. No one who did the exam for. Yes, Lydian, I'll basically try to see whether I'll be able to share the previous recording and also the materials. Yes, I'll be able to share that in the class WhatsApp group. So that point for today. We have a nice weekend. We continue from there next Tuesday. We will still be looking on this topic here on public sector accounting. So have a nice see you on Tuesday. You already have this question with you. I've shared this document with you in the class WhatsApp group. Have you seen this, Aziz, in the class WhatsApp group? Sharon, is the question in the class WhatsApp group? Yes, it should be there. It should be there. Yes. Okay. Okay. So basically, once we go through this particular question, we see what the candidates were required to do. Yes. So what are we told here? We are told 𝐼𝐍 Limited. 𝐼𝐍 Limited has prepared the following trial balance for the year which ended 31st of March 2025. So these are trial balance. So basically, we have the revenue. We have the cost of sales, selling and distribution, admin expenses, and then the structuring cost. I don't think this item was supposed to be here because you can see there is no figure associated with that. And basically, I've also counter-checked, and I've seen that there is no figure which is missing, because if we get these totals again, you'll be able to see our trial balance is basically balancing. Our trial balance is balancing. I hope you can see our trial balance is balancing. So what we will do, we will basically do away with this. We'll do away with this because no figure associated with that. Okay. So we have investment income. We have the interest paid on loan stock, land and buildings. Okay. We have land and buildings. We have plant and equipment. We have accumulated depreciation on 31st of March 2024. These are accumulated depreciation at the end of the previous year. And during the current year, there will be opening balances. So we have investment property. Remember, yesterday I was able to explain what are investment property. Basically, investment property is said comprises of two assets. One, land acquired by the company for it to appreciate in value and the company sell it in future. And number two, investment property also comprises of buildings which are leased out. They are generating some rental income. So those are investment property. But basically, in this case, I say, if the company owned any other building, a building which is used, for example, as a factory, a building which is used as a go down, a building which is used as administration block, does that qualify to be an investment property? Automatically, no. That qualifies to be part of the property, plant and equipment. So, but for any building to qualify to be part of the investment property, it must be generating some rental income. Some rental what? Income. That's basically what you need to just remember here. Okay, so we have then inventory at the end of the year, receivables, expected credit losses. Now, expected credit losses, basically, what do we mean by this? Expected credit losses. Now, expected credit losses, this previously what was known as the allowance for doubtful debts. Currently, we don't use that word. We use something called the expected credit losses. Why do we refer to this as an expected credit loss? If, for example, today you have a business and you have sold some goods to your customers on credit, so basically we say that you have given your customer some credit. You have given your customer some what? Credit. So if you expect that some of your customers or some of that money which is supposed to be paid by your customers will not be paid, that is an expected credit loss. You are expecting to incur some credit loss. You are expecting to incur some loss because you have extended a credit to your customer. So therefore, this previously what we were referring to as the allowance for doubtful debts, or basically the allowance, yes, the allowance or the provision for doubtful debts. Currently, we don't use that word. We don't use the word what? Allowance for doubtful debts. In fact, also the bad debts which are written off, we don't use that word currently. The bad debts which are written off, we use the word what? Credit losses. Credit losses, these are the bad debts which are written off. It is important for you to note that. In this paper for BDA, you will come across this word in so many questions. Credit losses, these are bad debts written off, which are part of the expenses. Expected credit losses, these are allowance for doubtful debts. And I hope you can be able to recall how we account for allowance for doubtful debts. You basically compare the allowance for doubtful debts at the start, or basically that's what you used to do in financial accounting, in financial reporting. You compare the allowance for doubtful debts at the start and also at the end. Basically, you determine whether you have an increase or a decrease. An increase, basically, that one you used to recognize that as an expense. But a decrease in allowance for doubtful debt, you are recognizing that as part of the other incomes in the income what statement. We are going to do the same this one. Yes, so we have that expected credit loss. We have cash and bank balance. We have the ordinary share capital share premium revaluation surplus, retained earnings. We have the dividends which were paid, 8% own stock, deferred tax, trade payables, and then suspense. Then from there, we have some additional information number 1, 2, all the way to note number 6. What are we required to do? We are required to prepare for publication statement of profit or loss and other comprehensive income. Part B, we are required to prepare the statement of changes in equity. And finally, we are required to prepare the statement of financial position. So this was a very, very simple question. Basically, I've said that this is a question which was examined last sitting, the sitting for August of 2023. So remember what you said is that once you come across such a question, are you supposed to do your solution in a new Excel worksheet? No. Basically, what we said, just split your Excel worksheet into 2. You have a question on this side, you have the solution on the other side like that. So what we will do, we will go to the other side. That's basically where we are going to have our solution here. So we need to have the solution here. But basically, before we do that, there is something we need to do. We need to go through the additional information. Basically, we see, are there some workings which are required? Are there some items we need to compute? Yes, so we said you can bold this one. To bold, we said you control B, that is to bold. Then you can also underline it. You control U to underline, and then you can also shade it, basically to be more clear. The person who is marking your paper should be able to see that. That is your solution there. Okay, so but before we prepare what is required, I want us to go through the additional information we see. Are there some workings we need to do? So in additional information about you're told, the following depreciation rates applies. So we are given the assets, buildings, and basically you're told the value for buildings is 30/30. The rate of depreciation is 5%, straight line. Remember, at a straight line, we compute depreciation based on costs. Then plant and equipment, 25% reducing balance method. Under the reducing balance method, we compute depreciation based on the asset net book value, based on the asset net book value. So I think we can basically compute that depreciation here. So the depreciation on buildings will be equal to this one. We said whenever you want to compute something within a cell, always start with the equal sign. I hope you can see what I'm starting with. Start with the equal sign, and the depreciation on buildings will be equal to 5%. We just pick this one, don't type it, times the cost. I hope you can see this is the cost of buildings, because in the trial balance, what you're given here, we are given land and buildings combined. Land and buildings combined. So the cost of land, we are told is 30/30. Is 30/30 here. So the cost of land is automatically the difference, 50/30 minus 30/30, which will give us what? 2,000. So therefore, the depreciation on buildings will be equal to 25% of the cost of the building. Remember here, we are only depreciating buildings, not land. So we take that, 5% of 30, and we enter. So that will give us what? That will give us 151.5. Depreciation on buildings, and I hope you can see that this one will be included as part of administrative expenses. We need to do the same for the other assets, plant and equipment, 25%. This will be equal to 25%. And because depreciation here is based on the net book value, so we need to multiply that. Okay, not on the net book value. Depreciation is to be computed using the reducing balance method. Under the reducing balance method, we compute the depreciation based on what? based on the asset net book value. The asset net book what? Value. How do we get this net book value of the plant and equipment? So we get those particular values here. So you can see plant and equipment is this one. So this is basically the cost. So what we will do, we will take the cost. You will take the cost there. And I think what we need to do here, we need to have the opening bracket before that, because I need to compute the net book value. Alternatively, let me make this more simpler. Let's first of all, we compute the net book value. The net book value. Remember, the net book value here we said is also known as the carrying amount. What would be the carrying amount of this plant and equipment? It would be equal to the cost, this one, minus the accumulated depreciation, this one. And that will give us 205. So to compute the depreciation, we're going to compute it based on that net book value. So we will take the rate here, this one, times this net book value here, which is 205. And we enter. So that will give us what? That will give us a 51.25. 51.25. That is basically the depreciation on plant and equipment. And I hope you can see here we are told that that one will basically be classified as part of the cost of sales. So we are done with that. And then you're told here in the last paragraph of note 1, meanwhile, land was revalued to shillings 2,400. So basically, once an asset has been revalued, we need to determine the revaluation gain or loss. The revaluation gain or loss. Basically, to determine that, we compare the cost and the revalued amount. The revalued amount is 24. Can you be able to get the cost? Can you be able to get the cost? Who can tell us how much will be the cost of the cost of land? Remember, this is the total value for land and buildings. And I hope you can remember in note 1, we are given the cost of buildings. The cost of buildings is 30. So what will be the cost of land? Who can be able to recall how we determine that? Or who can tell us how much will be the cost for land? The cost for land, let me see your answer. I see whether we are together. I'm told by Aziz it will be 2,000. Is that the position? What will be the cost of the buildings? Mary, Ruth, Sharon, T. What will be the cost of? What will be the cost? What will be the cost for land? Yes, in this case, the cost for land here basically will be what? Will be 2,000. Will be 2,000. Yes. So the cost for land will be what? 2,000. How do we get that 2,000? We will take this one, cost for land and buildings, and then we less the cost for land. I hope you for buildings that is 30. So that will give us 2,000. So therefore, this land had a value of 2,000 million. It was revalued to 2,400 million. So basically, it was revalued upward. So if it was revalued upward, which basically means that we have revaluation, we have revaluation gain. Revaluation gain. So the revaluation gain basically will be equal to this 24, this one, 24 minus the cost, minus its cost. The cost of that land was 2,000. So it was revalued upward with what? With 4,000. Then I hope you can also be able to recall, how do we recognize this one in our statement of profit and loss? How do we recognize this one? How do we recognize this 4,400 in our statement of profit or loss? In our statement of profit or loss, we recognize it as part of what? Other comprehensive what? Incomes. Other comprehensive income. So therefore, this one will be part of this one will be part of OCI. Other comprehensive incomes there. Okay. So we are done with that. And then you are told in note number 2, income tax for the year is 78 million. So this is basically the current tax. And then you are told, and the deferred tax expense besides that arising from revaluation above is 20 million. So we are given the deferred tax expense 20 million, but you're told this does not include the deferred tax on this revaluation. I hope you can be able to recall in a file and also AFR, in case the company revalue an asset and basically there is a revaluation gain, this gives rise to something called the taxable temporary difference. Taxable temporary difference. So what we do, we compute something called the deferred tax expense, the deferred tax expense on that revaluation gain. On that revaluation what? Revaluation gain. On that revaluation gain. On that revaluation gain. And how do we compute this deferred tax expense on the revaluation gain? So we take the revaluation gain, which is this one, and basically multiply that with the tax rate. Are we given the tax rate somewhere here? So in case the tax rate is not given, we use the rate of 30%. I don't think it is given. So we are going to use the rate of 30%. So we multiply that with 30%, 0.3 or just 30% like that. You can use 0.3 or 30% like that. So it basically means that this one is basically an amount of how much? Is an amount of 120 million. Now, who can tell us, how do we account for this amount here? How are we going to account for this deferred tax expense on revaluation gain? How do we account for this? Who can be able to recall this? Something you did in FR and also AFR. FR and also AFR, specifically that topic of deferred taxes. Yes, how do we account for this? How do we account for this one? How do we account for this? Yes, let me see whether you can be able to remember. So now this one, this amount of 120, number one, this one is basically debited in the account which is called the revaluation reserve account. So this one, we don't take it to the income statement, but rather this one is supposed to be debited in the account called the revaluation reserve account. A revaluation reserve, this amount in other terms will be deducted from this 400. In fact, when recording this particular revaluation gain in the income statement or in the statement of profit or loss, we record it net of the deferred tax. We will take this, we less the deferred tax. That's why we are saying we debit this account, because remember, revaluation reserve, this account should be always be credited. So by debiting 120, we need to reduce this. So this one, we are going to less that 120, and then we credit which account? We credit an account called the deferred tax account, the deferred tax account. So basically, to credit the deferred tax, we are going to increase the deferred tax at the start. I hope you can see this deferred tax. So this deferred tax basically will increase with this amount here, which is basically 20, and also this one. So the deferred tax by the end of the day will be 40, plus the deferred tax expense for the current year 20. So 40 plus 20 plus this. Plus what? Plus this. So that's basically how we account for that deferred tax expense on revaluation what? On revaluation gain. So we are done with that. So in case of any question, feel free to ask. Yes, and I hope you're together up to that point. Are we together up to that point, Ruth, Mary, Aziz, Josephine, Karibu? Are we together up to that point? Are we together up to that point? Okay. So let's then move to the other point. So in the other point, number 3, we are told the interest on loan stock is paid semi-annually on 1st of April and also 1st of October. 1st of April and 1st of October. Remember when this year ended? This year ended on 1st of 31st of March 2020. 25. So what we need to do basically is we compute how much interest was supposed to be paid in relation to those loan stock. And where do we have those loan stock? We have the loan stock here. So it basically means that this loan stock issued by a company were 8%, having a value of 18.25. So we need to confirm, or basically to compute how much interest is supposed to be paid for a whole year. It will be 8% times the value for the loan stock, this one. So it means that in a whole year, the company is supposed to pay 146. This is basically the amount to be recognized as an expense. But if you check in our trial balance here, you'll be able to see we are given interest on loan stock, which had been paid this one. And I hope you can see what the company had paid. The company had just paid 64. Had just paid what? Is it 64? Yes, 64 of that amount. And I hope they were issued. They had been issued at the start. Yes, because there is nowhere we are given the date of the issue. So basically, it means out of this interest, which was supposed to be paid, the company had just paid how much? The company had just paid this amount here. This amount of 64. It basically means that the difference between these two values, this one, and what the company had paid, this one. So this one was accrued. This one was accrued. So, and being an accrued, this one being an accrued, automatically this one would be accounted for as a current liability. This one would be accounted for as a current liability because it was not yet paid. And then number two, when preparing our statement of profit or loss, how much amount are we going to capture there? The amount which will be taken to the statement of profit or loss is the interest for the whole year, the interest for the current year. This is the amount you're going to recognize in the statement of profit or loss. Statement of profit or loss, not actually what was paid, but basically this is the interest which the company was supposed to pay during the current year. During the current what? During the current year. Okay, so we are done with that. And remember that interest on non-stock, that would be part of that would be finance cost. So we are done with that. So then number 4, we are told investment property had a fair value of 122 million at the end of the year. Remember, investment property, this asset should be accounted for in accordance with International Accounting Standard number 40. And actually that standard IS 40 requires investment property should be revalued to their fair value at the end of each year. Should be revalued to their fair value at the end of each year. Any increase in the fair value is supposed to be recognized as part of the other incomes, not as part of the other comprehensive incomes, but as part of the other income. So what do we need to do? We need to compare this fair value at the end of the year, which is basically 122, with the fair value which we have in the trial balance. And the fair value for the investment property in the trial balance is basically what? Is 2,400. And which value have we given down here? Okay, it's 122 basically, yes. Is 122. And this is what? This million. And this what is happening here? So this one is 122 million. What about the other figure which is up here? Is 24. And still our figures here are in million of shillings. So is that or was that figure supposed to be 122 or basically on 22,000 million? Okay, because this one is what is 122 million, 122 million, 122 million, and basically the other one is what? The other one is this. And remember, this is also in millions. Remember, this one is also in millions. In millions. What is happening with these figures? Are they supposed to be like that? Let me type it here. 24 million. 24 million. And then 122. 122. I don't know whether the figure has a problem, but I think that figure must be having a problem. That figure must be having what? Must be having a problem. But basically what we will do, we will have to work with that figure the way it is. But automatically, this figure was supposed to be more than this. Was supposed to be more than this. Because in most of the questions, what will happen is that you'll be given the fair value at the end of the year being higher than the fair value in the trial balance, such that that increase, you account for it as part of the other incomes. You account for it as part of the other what? Incomes, as part of the other incomes. This figure, which is in note number 4, that figure must be wrong. Must be wrong. Must be wrong. I don't know which figure we are going to work with. Maybe let me quickly counter check from the original question here, because this basically question was borrowed from another paper. I see which was this figure. Let me quickly do that. Quickly do that. Yes, I can see this particular figure here. This one was supposed to be, because this is a question borrowed from a file, this was supposed to be 2440. We are going to change that to 2440. Sasa, yes. So you take note of that. Take note of that we have changed that particular value there. We have changed that value. So that was supposed to be 2440. Remember, I've said this is a question basically borrowed from a file. So this one will be 2440. This one will be 2440 like that. 2440 like that. So it basically means that now, if you compare these two values, the fair value at the start, which is 24, the fair value at the end, then you can see we have an increase. How much is the increase in the fair value? The increase in the fair value is basically an amount of, okay, this one, we can't get a correct figure, but basically the increase here should be 40 what? Should be 40 million. Should be 40 what? Million. Now, how do we account for this particular 40 million? How do we account for this 40 million? So this particular 40 million, remember, is known as a revaluation gain on investment property. Revaluation gain on investment property is basically part of the other incomes. In fact, this one, we are going to add it to the, this one will be added to the gross profit. This one will be added to the gross what? To the gross profit, simply because it is part of the other what? It is part of the other incomes. It is part of the other what? Incomes. Part of the other incomes. Part of the other incomes. Part of the other incomes there. Okay. So then number 5, we are told the suspense account related to the issue of 2 million new ordinary shares for cash of shillings 120. And then you are told one share has a par value of 100. So basically, we are told that the suspense in the trial balance, this one, relate to shares which were issued. How many shares had been issued by our company here? The company had issued 2 million shares at a price of 120. So how much amount was received from the issue of those shares? So we take the shares which were issued, 2 million, we multiply that with 120 shillings, the issue price. So basically that will give us 240 million. So that 240 is the amount now which is credited in the suspense. So once the company issues shares, and I think we came across a similar transaction in the other question we did yesterday, we said the company should debit bank and then credit ordinary share capital and the share premium. So instead of the company crediting the share capital and the share premium, the company credited which account? The suspense. So therefore, we need to make the correct entry. So out of this amount here, how much amount are we going to credit in the ordinary share capital? The amount to be credited in the ordinary share capital, we said, is always based on the par value here. I hope you can see the par value. The par value is what? Is 100. So we will take the shares which were issued 2 million times 100. That will give us, that is 2 million times 100. That will give us 2 million. 2 million. This 2 million will be added to the ordinary share capital. The amount which is basically above, not 2 million 200, The difference between these, that is the share premium. So that one will be credited in which account? This one will be credited in the share premium. In other terms, when preparing the statement of changes in equity, this one will be added to the share premium. Will be added to the share premium there. And I think in our case, basically we are done with that. So let's move to the other note number 6. And basically you're told that the company had not adjusted a credit loss of 15 million. What is a credit loss? Remember, there is something I've explained. Nowadays, we don't use the word bad debt written off. This is a key term you'll come across in so many questions for BDA. The term credit loss. Credit loss, these are bad debts written off. The company had not adjusted this, had not accounted for this. So anytime the company writes off some bad debts, how do we account for that? So these bad debts which are written off of 15 million and which had not been adjusted by the company, number one, we less the trade receivables. We less the trade receivables. We are going to less the trade receivables, an amount of 15. And then this 15 is an expense. So, and specifically, we recognize this as part of distribution costs. We recognize that as part of the distribution what? As part of the distribution cost. This amount had not been accounted for by the company. It is a distribution expense. And number two, we less it from the receivables. Then you're told the expected credit loss. Now I've said expected credit loss. This now what we used to refer to as the allowance or the provision for doubtful debts. So the expected credit loss on the remaining trade receivables is determined from the following probability of default. So we are told this is selling and distribution. So we are given the expected credit losses. So these are those particular amount which are expected not to be paid, but now we are given the probability of default. For example, an amount of 260, the probability of default is 5%. So what does that mean? It basically means that out of this amount of 260,000 or 260, and I think this one is wrong because I hope you can see all our figures are denoted in millions. This one equally should be denoted in millions. This one should also be denoted in what? In millions, not in thousands. Not in thousands. This one should be denoted in millions. So we are told the company expects that out of this amount of 260, the probability that it will not be paid, or basically out of this 260, 5% of it will not be paid. That's what you mean by probability of default. 5% of this will not be paid. 20% of this will not be paid. And 40% of this will not be paid. Now, what do we do in such a case? What we do, we need to create a provision for doubtful debt. And the provision for doubtful debt, I'm saying, that is now what is currently known as the expected credit loss. And basically, we need to compute that. So we will take 5% of this because 5% of this is the one which is expected that it will not be paid. We create a provision for that equivalent to 5%. So we take 5% of this, we enter. So we do the same to this. We do the same to this. But basically, we say once we have developed a formula within Excel, then you just need to apply that formula. So like we already have the formula, and I hope you can see our formula up here. So to arrive at this value, we have taken this times this. So what we need to do is basically we bring our cursor here and we apply that formula to those two other rows. Basically, by default, Excel would be able to compute for us these values. For example, if you check what is this, you just click that cell and then you come up there. So that value is arrived at as 20% of this. What about this one? This one is basically 40% of this. So therefore, the expected credit loss, the expected amount not to be paid by the debtors is how much? 68. So this basically the expected credit loss at the end of the year. Now, what we need to do, we compare this with the expected credit loss, which are given in the trial balance. So remember, I said this is just equivalent to allowance for doubtful debt. We used to compare the allowance for doubtful debt at the start and at the end. So we already have the allowance for doubtful debt here. Where do we have it here? Where do we have it? We have it here. So basically, we're going to compare the two values. This is basically at the start, 58. and this one is at the end. We determined, do we have an increase or basically a decrease? And as you can see, in our case, we have what? We have increase in expected credit losses. In expected credit what? Credit losses. Expected credit losses. So how much is the increase here? How much is the increase? The increase will be equal to 68, which is basically at the expected credit loss at the end, minus the expected credit loss at the start. And that one increased with an amount of how much? Increased with an amount of 10. Who can be able to remind us? How do we account for this one? How do we account for this one? How do we account for this? In the income statement, how do we account for it? Yes, who can be able to recall? Yes, we account for this basically as an expense, specifically as part of selling and distribution. As part of selling and distribution. I think in our case, we are done with the workings. So what we need to do is basically we go through to preparing what is required. We will start with part A. We said whatever you can be able to copy, avoid a lot of typing. So we highlight all that. We say Control C to copy. And basically we have it here now. We have it here, Control V, Control V, Control V, Control V. This is basically the statement of profit or loss for the year which ended 31st of March 2025. So we can equally shade that like that. And then also we need to have a single column, and our figures here will be in million of shillings. We need to indicate up there that our figures are in million of shillings. How do we prepare this one? We basically start with what? We start with the revenue. So we pick the revenue here. We basically copy. We paste that here. We paste that here. I don't know whether we reduce the font a little bit here. Yes, I hope you can be able to see my font. Is it too small or it is okay? Is it okay? Can you see what I'm presenting from your side, Josephine? Okay, sawa. Okay, so basically revenue is that particular amount. So is there any adjustment? No. So to this, then what do? We less the cost of sales. We less the cost of sales. Cost of sales, this one is already computed for us here, but I think will it be having some adjustment? Do we have any adjustment which we need to make to the cost of sales? Yes. I hope you can see like we have depreciation here. So we need to make the adjustment here. So the cost of sales will be equal to whatever you have here, but I need to start with the opening bracket because by the end of the day, I'll have to multiply that figure with the -1 to change it to a negative. So we take this, and then to this, I need to add. I need to add this depreciation here. Anything else to be included within the cost of sales? As per the workings which you have done here, nothing else. So I'll close the bracket, and basically I then multiply that with -1, basically to make it a negative, because our cost of sales here should be a negative. Should be what? A negative. And then, okay, sorry for that. I needed to introduce a comma, not to get the total. I needed to introduce a comma here. Because we said anytime, for example, your figures appear negative, you can see this figure is negative. In accounting, a negative figure should not be recorded like this, but should automatically be inside the bracket. What do? Introduce a comma here. This one, like that. Yes. So you can see now that our figure is inside the bracket. Then we need to get the gross profit. We just do the auto sum here. So this now will be our gross profit. This will be our gross profit. And basically we can equally bold this one, bold. We say Control B. We equally underline this. We say Control U. And basically we say that as we move forward, you need to note those shortcuts somewhere. How to bold, how to copy, how to paste, how to underline. Those are the obvious shortcuts you should be able to remember. So to this, then we have said we do what? We add other incomes. We add other incomes. So which other incomes do we add here? I think in our case, we have a number of other incomes. I need to bold this one. So from this trial balance, when checking for the incomes, you check items appearing on the credit side, the last column of the trial balance. So this is the revenue we have already captured. That we have this investment income. I'll just pick this one. I copy, I paste it here. Then I'll bring the figure here for the investment income. How much is it? 120. Any adjustment? No. No. So that is basically we have dealt with that. We have dealt with that. We have equally dealt with these two items here. We say that once you have dealt with an item, it's always important you shed it to make your work easier. So these are accumulated depreciation. Those are not incomes. Expected credit losses is not an income. All these are items of equity. Loan stock, deferred tax. Basically, we don't have any other component of income here or any other income here in the trial balance. But I can remember in the additional information, we had an item to be recognized as part of the other incomes, and that is this revaluation gain on investment property. Revaluation gain on investment property as per IFRS 40, as per IS 40, not IFRS 40, International Accounting Standard number 40, that one is supposed to be recognized as part of other incomes. The revaluation gain on what? On investment property. On investment what? Property. But remember, in this case, you have said any revaluation gain on PP is part of the other comprehensive income. And I hope you can remember this value is 40, this one, this 40. 40, yes, we put it there. 40. Yes. Do we have any other income? No. So I think what we need to do is basically proceed with the expenses. I think expenses, we can first of all pick those two. We copy, we paste them here. So selling and distribution will be equal to what we have here, this one. Is this having some adjustment? Yes. So therefore, what I need to do basically is to start with the opening bracket. This one will be equal to this. Then the number of items I need to add here from the workings. This depreciation is part of admin. Then we have working note 2, 3, 4, 5. Yes, so we have this note number 6. In this note number 6, we have this amount of credit losses which are not being accounted for, 15. We add it there. And then we also add, and basically I say that whenever you're doing those workings, do I need to go back to the statement of profit or loss? I see what is happening there. No, all the workings you are doing appear here. So that's why you don't have to go back to the income statement. You see what is happening. So anything you're typing is appearing up here. Sasa? Yes. So we have taken the amount given in the trial balance plus this plus now the increase in expected losses, this one. This one. And then what we need to do is basically cross the bracket. And because this is an expense, it has to be a negative. We multiply that with a -1. Okay. We multiply that with a -1. I think I've already entered. Yes, but basically this is what you have done. Yes. So you have taken this amount plus the credit losses written off plus the increase, and then I've multiplied that with -1 to make it a negative. What about the distribution? Sorry, not the distribution, rather the admin. I will do the same. I'll take this, and then there is a depreciation to be included here. That depreciation in note number 1, this one. We added anything else to be added there? I think no. I think no. Then I need to cross the bracket. I basically multiply that with the -1 to make it a negative, and that will be the final figure for administrative expenses. So then finally, remember we have dealt with those two expenses. Maybe you can shade them. So then from there, we take this interest on loan stock. The interest on loan stock, this basically, we refer to this as finance cost. This as finance cost. And I think I've seen Aziz asking about semi-annually. because there is that information which you're given here. That information basically is just to confuse you. As is, what you just need to know is that as far as these loan stock are concerned, you just need to compute the interest for that year. The reason why you're told it's paid semi-annually, it means that when the year is coming to an end, part of the interest on the loan stock are not being paid. So you are not even concerned with that. Although I think you have already computed that. So, but what you need to compute is the interest for the current year. And the interest for the current year, I've said, you take 8% of this value, which has given us what? 146. And then out of this, the company had only paid 64. The difference, which is 82, we have said is a current liability. So what we recognize here is the expense for the current year, this one. Do we have any adjustment for that? No. I just need to convert that to a negative by multiplying that with the -1 like that. Like that. Sasa? Yes. So basically we have dealt with this one, which is an expense. Which is an expense. Okay. Do we have any other expense? Remember also when checking for the expenses, we check the items appearing here, appearing in the debit column of the trial balance. So all these are basically assets. These are assets, cash, asset. This dividend is not an expense. Yes, and I think in our case, basically we are done. So what we need to do now is basically we get profit before tax. We get profit before tax. So the profit before tax, we will take this one. We do auto sum here. Yes, basically this plus this minus those expenses, and basically we are getting that figure we had right hand, and equally we do what? We bold Control B there. So to this then we proceed and we do what? We less the income tax expense. Income tax expense. So for the income tax expense, this comprises of two components of tax, the current tax. So the current tax and the deferred tax. But in our question here, we have a deferred tax expense. If you can recall the question we did yesterday, we had the deferred tax what? Income. So the deferred tax expense, the deferred tax expense, where do we have that? We have it in note number what? Note number, this one, note number 2 is 78. That is the current tax. 78, maybe you can just type it as a negative directly. Negative 78, like that. What about the deferred tax? The deferred tax basically is 20, this one. The deferred tax beside the revaluation, the deferred tax on the revaluation gain. So this deferred tax on the revaluation gain, we have said that this one is not taken to the income statement. Rather, it is deducted from this revaluation gain. So we have 20, this one. Negative 20 like that. So we enter. So then we proceed and we get what? We get the profit. The profit after what? The profit after tax. So the profit after tax, basically we do the auto sum here. Yes, and then we do what? We bold this one. And then we equally underline this, Control U to underline. Yes. So after this, we proceed and we add now the other comprehensive incomes. The other comprehensive incomes, OCI. And equally, for example, anytime you want to do some changes, you have typed something is wrong, don't type it within Excel here. So highlight that item you want to edit, and it will appear up here. You do all your editing here. Sasa? Yes. So because if you try to do the editing here, you can do it here, but it will give you a lot of work. Do all your editing up there. So the other comprehensive incomes, basically these include, we only have one, and that is the revaluation. Revaluation gain on what? On land. Revaluation gain on land. And basically that revaluation gain, I hope you can be able to recall, it was 400, this one, but basically we have to less this deferred tax. So we are going to record it here net of that deferred tax. So we will take 400 minus the deferred tax expense, which is basically 120. So that will give us an amount of how much? 280. So I think in our case, we are basically done. We need just to add those two values there. And we get what? We get the total comprehensive incomes, the total comprehensive incomes, total comprehensive incomes, total comprehensive what? Income. So basically, we are done with what is required here in part A of that question. We are basically done with what was required here. So this was a very, very good question. Although I think the only tricky part was in relation to these expected credit losses. I think that was the only tricky part. But I think for the other items, this one was quite simple. And for example, in this question, you may ask, how was it marked? How is such a question marked? So the marks allocated to that part were basically 8 marks. And for each correct entry, you get 1 mark. For every correct entry which you are recording here, you get 1 what? You get 1 mark. You can see there are some free marks here. For example, for this tax, this current tax, this deferred tax, those are free marks. Also, if you were able to compute this revaluation gain, but you also less the deferred tax, is 1 mark. Maybe, and all these items here. Investment income, revenue, you can see that one does not have any adjustment. Revenue, yes. So basically, the marks allocated there were 8. For every correct entry here, you get 1 mark. You get 1 mark. So let's move and basically do the other part because of time. We finish on time. So we copy this and then we paste it here. Yes, so basically what we said is that whenever you're doing this particular question in an examination setup, avoid a lot of typing. Avoid a lot of typing because that's now what will be consuming your time. Whatever you can be able to copy. Whatever you can be able to, or what you can't be able to copy, that is maybe what you need to type. Yes, avoid a lot of typing there. Yes, so how do we prepare this? We prepare this, remember, to show why there was a change in the various items of equity. So here we always start with the details column, and then basically you're going to have the various items of equity. So we have the items of equity here, starting with ordinary share capital, share premium, revaluation, retained. So what we will do, we will copy all this. Basically we say Control C. And then you can see those items appears now in what? In loss. But once I bring them here, I want those items, each item to appear on its own column. What will I do? I'll basically let the first item start from there. What I'll do, I will right click, and then I will be able to use this particular function here to transpose. To transpose is basically interchanging items appearing in rows now to appear in column. Yes, you can also use the same function to interchange items appearing in columns to appear in what? In rows. Yes. And then we say that you can come here and you do what? You wrap this to basically appear in the words to stop hiding. We lap, we equally lap, but you can do then for all instead of doing for individual item like that. Yes, for this one, maybe you can do away with the date here. The date is not important. Equally here, you can center this. You can also bold it like that. Maybe for this revaluation reserve, you can make it a little bit bigger like that. Yes, and then finally, what we need to do is we add the total column there, the total column there, like that. Yes. Now, what we start with here, basically the opening balances, we start with the balance brought down. The balance brought down, basically the balances we have in the trial balance. All these balances here, these ones, we will pick all these balances. We copy all of them, copy. and then we paste them here. What you're going to do, we are going to transpose like that. Yes, and then we get the total there. Yes, so then we need to take into account the transactions which occurred during the current year and basically which affected these items of equity. Maybe we can start with the profit after tax from a statement of profit or loss. So a profit after tax, this will go to the which column? The retained earnings column, this one. So where do we have profit after tax? Whatever you have computed up there. What else do we have? I think during the current year, we have this revaluation gain. I'll just copy that one. I bring it down here. And this revaluation gain will go to which column? This one. And also we record it here net of deferred tax, this one. We record it as 280. What else do we have? I think we have in the trial balance, we have some dividends which were paid. Where do we have those dividends? We have these dividends. We copy this, we bring them here. Remember, you have said that dividends should be paid from basically what? The profits. So we take that to the column for retained earnings, this one. And that is an amount of how much? Dividends paid. Dividends paid is basically 100, but that one we must record it as a negative. I'll have to multiply that with a -1 to make it a negative like that. Yes, what else do we have? Yes, I think we have dealt with all these items here now. All those items we have dealt with them. What else do we have? I can remember we had in the additional information, we have this transaction for the issue of shares. Where do we have it? We have it here, shares which were issued. There was issue of shares. Issue of what? Of shares. Now the shares which were issued here, basically they had a value of 200, which we said we are going to add to the share capital, and to the share premium we add 40. So to the share capital here, we add 200, we add 200, we add 200. To the share premium here, we add what? We add 40. We add 40 like that. We add 40 like that. Yes. Anything else which is remaining to be captured there in our statement of changes in equity? Anything which is remaining? Aziz, Mary, Josephine, Sharon, T, anything which is remaining which we have not captured here? Anything which is remaining which you have not captured here? Anything which is remaining? I think none. I think none. We have been able to capture all items. We have been able to capture all items. So I think now what we need to do basically is we get now the totals. Maybe we can get the totals for each column, for each row. Basically, I've gotten the totals across, and then we get the totals for each component of equity here. Each component, and then equally I can introduce a comma here. Yes, so this now will be the balances carried down. This will be the balance carried what? Carried down. Carried down. The balance carried down. Basically, the balances at the end of what? At the end of the year. Remember these balances at the end of the year. Basically, this is what we transfer to what? This is what we take to the statement of financial position. The statement of financial what? Position. Yes. So just confirm whether we are together up to that point. Are we together up to that point? I want us to wind up by basically preparing the last item. The last item. If we are together up to that point, maybe you can just confirm. Are we together up to that point, Josephine? Are we together up to that point? Okay, so let's prepare the last component, which is basically what? Which is the statement of financial position. So we basically copy this one. We copy that, Control C, Control C, Control V, we paste it here. We paste that here. Yes. So here we basically need to have a single column here. And also we need to indicate our figures and in million of shillings. In million of shillings here. We paste that here. Yes, I will start with the non-current assets. I will start with the non-current assets. So for the non-current assets, basically we said we start by recording the property, plant, and equipment. And for the property, plant, and equipment, basically we say that this one include all tangible non-current assets. All tangible non-current what? Assets. So PPE, property, plant, and equipment, this comprises of what? All the tangible non-current what? Assets. Sasa? Yes. So what we need to do, that. I will get the total net book value for all tangible non-current assets at the end of the year. And basically I'll start with what I have here. I'll take landed buildings, this one. So the number of adjustments I need to make here. One, remember land was revalued upward. So what I will do, I will first of all add the revaluation gain on land. The revaluation gain on land is this amount 400. So, and basically I'm saying is not a must. I must keep on going back to my statement of financial position. I see what I'm doing. All what I'm doing is appearing up here. That's yes, I've taken the value for landed buildings given in the trial balance. I've added this value. And then in this case, because buildings are also depreciated, I will less depreciation for buildings. First of all, I less depreciation at the start. This one is at the start. And then minus depreciation for the current year. Where do I have depreciation for the current year for buildings? I have it here. I hope you can see what I've done here in relation to landed buildings. I've taken the cost of landed buildings at the start. I've added the revaluation gain, and then I've deducted the two depreciations. Then to this, I need to add the net book value for the other tangible non-current asset, which is that it is plant and equipment. I'll take the cost minus the accumulated depreciation at the start, this one, minus the depreciation of the current year. The depreciation for the current year here. For the current year. So, and basically that now will give us what? That will give us the net book value for all tangible non-current assets. I've taken landed buildings, plant and what? Equipment. So then I'll do what? I'll just enter. So this now will be the final value here. And we say, if you want to know how this value has been arrived at, we just highlight that cell and the formula for computing that appear up there. And once you click at the end of that formula, all the values which are used in computing this value will be highlighted. Will be what? Highlighted. For example, if you want to see this value, you'll check the cell which is highlighted in. Is this green? I think so. Is this color green? Josephine, Mary, is this color green? This color green? Yes, I think should be color green cell. You basically go to the cell which is highlighted in green. You'll be able to see that value. Yes. Yes, yes. So basically that's how we compute that. Then which other non-current asset, and basically because maybe those items which you have already dealt with, we can just highlight them. We have dealt with all these items. So then I have this investment property. I will copy this. This is also a non-current asset. Investment property. So the investment property, the value I will record here is the investment property at fair value. And remember here, the investment property is per note number 4. They were revalued at the end of the year to a value of 2440 here. 2440. 2440. That is basically the final value. So not at the start. I hope you can see I've not picked this value we have in the trial balance, but basically I've taken the fair value at the end. I've not used this value here. But rather I've used the value at the end of the year, the fair value at the end of what? Of the year. Okay. So I think we are basically done. Remember also we dealt with this one. Remember also we dealt with that. Yes. So I think we don't have any other item of non-current assets. So next I need to proceed and I record items of current assets. Items of what? Current assets. So for the items of current asset, I think we have a number of them. We have a number of them. We have a number of items of non-current what? A number of items of non-current assets, of current assets, sorry. They will include what? They will include, remember all items of current asset, we have a debit balance. We have these 3 items. I'll also control and I'll pick all of them, copy, okay. Okay, you should be able to copy all these. Copy, yes, you should be able to copy that, and then we paste all of that here. All those are items of current asset, and then I will be able to bring the values here. For the inventory at the end, basically that is a value of what? Of this one. We take it there. I basically enter what is happening. Okay, let me see what is happening. Okay, yes, now it should be okay. So what about this one? We say this one will be equal to this one, but I think there is a figure which is to be adjusted. Sorry for that. The receivables figure, this figure will be adjusted, because remember there were some credit losses which were written off, or the credit losses, but which are not being accounted for, including the expected credit losses. So what I'll do, I'll take this value here, 933. There are a number of items I need to less there. One, I will less this amount of 15. This credit loss, remember I said, is the amount which was written off, the budget written off. Okay, I've said I will take what? I will take this minus. We must type minus before we pick this, minus this one, 15, minus the credit loss, the expected credit loss at the end. The expected credit loss at the end is this one. I get the final value. The final value will be what? Will be 815. Actually, that one should be here. Okay, need to redo that afresh. So we have said we pick this minus what we have here, 15, minus the expected credit loss at the end, that one. Yes. So that basically will give us what? 850. So what about the cash and bank balance? The cash and bank balance, no adjustment for that. We just pick this value here. Yes, and I think we are done. We are done with those 3 items. We can equally shadow this because we are done. So maybe down here we can check. Do we have any other item of current assets? No, all these items are current liabilities. What about the additional information? Additional information, you have dealt with the number 1, 2, 3, 4. I think basically we are done. So what we need to do, we can get the total assets. And equally here can introduce maybe a comma here. Yes, so I just need to get the total assets. Okay, that is auto sum. Yes, which will give us 8720, 8720.25. So this will be what? This will be our total assets. Our total assets. So basically, I need to bold this one, Control B. I also need to arrange these 2 figures, Control what? U, like that. Yes. And basically, we are done. We need to move, and now we are almost done. So we record the items of what? Equity. The items of equity. So for the items of equity, what do we record here? Whatever you record here is what we have in our statement of changes in equity. All these items, I will just copy all these. Copy. And then I bring all of them down here. And because you can see they are appearing in columns, I need them to appear in rows. I will just use this function of transposing this one. And then you can see they are appearing in one cell. So I need to lap like that, And then I need to align like this. I use that function to align what? right, like that. And then I can also unbold this one. I can unbold them because they are bolded. I can unbold them. I will say Control B, Control B, and then I will be able to bring those figures, which we have here. This, I don't know whether this formula will work. No, I think we need to bring the individuals. 83, and is that 83 correct? Okay. The share premium there was okay. That is okay. So the other one is this one. Then we have this, and then we have the total, this one. Yes, like that. So basically in our case here, we are done with that. So we can arrange that, Control U. And then next, what do we record? We record the non-current liabilities. The non-current liabilities. So for the non-current liabilities, we have a number of items to be recorded here. I hope you can remember some of them, including the deferred tax, including the loan stock. Yes, so I'll basically pick these items here. Control C to copy, and then I paste them here, Control V. So the 8% loan stock, the value for this remain the same. The value for this remain the same as the value in the trial balance. As the value in the trial balance, this one remain the same. What about the deferred tax? The deferred tax, basically, we will do what? We will take this deferred tax here in the trial balance, and then this deferred tax, basically, we are going to adjust it. We are going to adjust it with two items. Which are those two items? One, we said, to this, we need to add the deferred tax for the current year. You see, this deferred tax expense. A deferred tax expense basically is an increase in the deferred tax. If you can remember the question we did yesterday, we had a decrease in deferred tax. And actually a decrease in deferred tax, we said, is an income. And number two, we also recognize that as part of the other income. So therefore, in our case, what we need to do here, this being a deferred tax expense, it will increase our deferred tax. So to this 40, number one, we add this 20, this deferred tax expense in note 2, and also we add the deferred tax on the devaluation gain, this one. We said we credit the deferred tax. Basically is to add. We do what? We add. That should be 40 plus the 20, which should be 60, plus 120, that should be 180. So that is basically the deferred tax at the end. So finally, what do we record? We record the current liabilities. Current liabilities. Now for the current liabilities, remember you have dealt with these two items here. So the only, and also we dealt with this one. This is related to the issue of shares. I think we only have one item which is appearing here, and basically which is payables. Do we have anything else? No. So we have payables here. Will this be having any adjustments? Any adjustment for this? Any adjustment for this? No. No adjustment. No adjustment. So the amount remains the same as given there. But I think in the additional information, do we have some items do we need to capture here? In additional information, number one, no. But in note number 2, this income tax we said will not have been paid. If it was basically paid this current tax, this income tax expense for the current year should be in the trial balance. But because it was not paid, we recognize it here as part of the current liability. So we refer to it as the current tax, a current tax payable. Current tax, a current tax payable. The current tax payable is basically a figure of what? Of 78. 78. And then what else do we have here? I think we have dealt with the note number. Yes, in relation to note number 3 here, remember there was the accrued interest. Accrued interest is basically interest which are not being paid. Accrued interest which are not being paid. And I think we have already computed that accrued interest. That interest which are not being paid That interest which are not being paid, where do we have that? It is this value here, which is 82, which is basically 82. Do we have anything else? Note number 4, note number 5. Yes, basically we are done. We are done. So what we need to do is we get the total equity and liabilities. Total equity and what? And liabilities. Total equity and liabilities. Total equity and liabilities. Total equity and liabilities, we need to add all this. And basically should be the same with the total assets. We add the insert. Is it the same as total assets? Yes, yes. Because you can see our total asset up there is 8720.25. The same case with what? The same case with total equity and liabilities. Yes, so that is it. That basically what is required as far as that question is concerned. That is what was required. Was the question challenging? How was that question? How was the question? Ruth, is the question challenging or is it doable? Josephine, T, Mary, how is the question? Is it a manageable question or is a difficult one? How is that particular question? How is the question? Before I tell you how the marks were allocated, how is it? Is it a doable question or is a little bit challenging? Yes, so this one is a manageable question. So the marks are allocated basically here in this last part. In this last part, the marks are allocated here were 8. 8 marks. 8 marks are allocated here. 8 marks, and basically the marks are allocated here were in the statement of changes in equity, the marks are allocated there were 4 marks. 4 marks there. Statement of profit or loss, the marks are allocated there were, I think I said were 8. Were 8 marks. Were 8 what? Were 8 marks. So that is it. That basically what was required in that particular question. A question in relation to preparation of what? The published financial statement, published financial statements. Yes. And basically now that brings us to the end of that subtopic. Remember, it's still at the financial reporting. I think so far we have looked on how to prepare a statement of cash flows. We have looked on how to prepare the public financial statements. I think once we meet in our next class, we're going to look on something which is very, very simple, and that is the analysis of financial statements. Analysis of financial statement, remember, is a topic you did in still in FR and also in FM. We're going to look on three tools or basically components of analyzing financial statements: computation of ratios using Excel, something known as the common size or the horizontal analysis of the income statement and the statement of financial position, and also we are going to do something to do with the trade, or basically the horizontal analysis. So I think those or basically that's what we will do once we meet in our next class. Our next class, maybe for those who are joining for the first time, will be on Saturday at 6 to 8. 6 to what? To 8. So for today, basically I want us to we stop at that point. I don't know whether there is any question before we wind up. Is there any question before?
coding. So now we have missed something, but no problem. So we are saying, so maybe just a recap. So we have said time value of money, it is that the fact that over time, the value of money changes. The value of money does not remain the same. And I'm saying, assuming here, now, that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. Which one is better? And we said, holding other factors constant, because there are other factors, that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million, because this, it may be, if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount was be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Oh, okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable, because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value, or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction, and we have this direction. So this is to say, you can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But we want to know what is the worth? What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting its determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you're supposed to compare the two, you cannot compare when they are not in the same form. You're supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money, introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, yeah, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why there they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number 1. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding, or compounding techniques, and we start with the first one: future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal: 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And we say, when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you are paying or receiving 400,000. That is an annuity. Or each year you are paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year 1, you'll receive 300,000. In year 2, you're getting 550 or paying or 550. Year 3, 600. Year 4, 700. Maybe let's say year 5, 300,000. you cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000 that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year 1 and year 2, or period 1 and period 2, we have an annuity of 300,000 because they follow each other. Yeah? But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year 1 and year 3, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear. A lump sum and an annuity. This is a concept that we are going to use a lot in financial management. And that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus r power n. Principal times 1 plus r power n. And this is what we call present value. Present value. This principal figure here is what we call present value. Let's see. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of a future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future. No. Equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus r power n. This factor here, this factor 1 plus r power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus r into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return. It's important for you to write this formula. Just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Eh? Yeah. Do we have an example there? So the example, yeah, there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount, is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20% per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annually. Determine the future value of the investment after 3 years. N, we should have said N here. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value, we are saying, is equals to present value 1 plus R power N. So future value is equals to 100,000 times 1 plus 0.2 power 3. Power 3. So get the value of the investment after 3 years. Value of the investment after 3 years is how much are you getting? There are people, no, but you must be knowing how to put this power 3 in calculators. Anyone who doesn't know, you will be assisted. Now, for example, we have two answers here. We have 172,800 and we have 106,120. Alice, I'm doubting your answer. At a rate of 20%, even in the first year, we are going to earn 20,000. Because first year one, we will say 20% times this. Times 100,000. That is 20. That means it's more than 106,000. So 178, probably 172,800. 172,800. Alice, repeat your calculation. Okay, yeah, 172,800. That is what you're supposed to do. Another method of getting this. Another method of getting this is or. So here you say or a very long method. You'll say period here. Period 1, 2, and 3. Amount. Amount with, let's say 100,000. No, will that give us? No, that is the only way. Okay, the other method is where we say, but this one is very long. Where you say here it's 1 plus 0.2. The figure that you'll get here, you bring it here. Then you continue. But that will not apply in this case because we are only investing 1. So you can continue. You grow by that rate. So just stick to this. Just stick to this. Any question before you continue? We want to proceed. Okay, number 2, future value of an annuity. Future value of an annuity. Future value of an annuity. Future value of an annuity, and you've seen how we get the future. I've explained what's an annuity. Future value of annuity. Future value of annuity. Now, a future value of an annuity, just like we've said, you get the annuity. It's an annuity when the amount occurs repetitively, but regularly. So future value of an annuity is computed as follows. Without wasting a lot of time, future value of annuity is equals to the annuity. You get the annuity amount times annuity amount times. So we have the future value annuity factor. The future value annuity factor, you say 1 plus R power n minus 1 over R. That's how we get the future value of an annuity. 1 plus R, and write these formulas because the way they are in the handout. Okay, they are very much simplified in the handout. Just write what I'm writing on the board. Yeah, it's there, but write. Future value of an annuity is equals to annuity times 1 plus R into brackets power n minus 1 over R. This factor here, the factor 1 plus R power n minus 1 over R is called future value interest factor of an annuity. Future value interest factor of an annuity. What have they said there? Future value interest factor of an annuity. Future value interest factor of an annuity. This one. Now, we have tables. We have tables where these factors can be read from. Like, you remember what table do we have? We have math table. Do you people know what's a math table? Or maybe what we call what? Normal curve, normal distribution curve. We have tables. We have tables where you can read these factors. When we go to discounting, I'm going to share the tables so that we can see. But for future values, the tables for compounding, it's not widely used in financial management. So just get these formulas right. Yeah. So any question here? There is nothing to explain. We know R is the rate of return or the interest rate, and it's the number of periods. So there is nothing to explain. Let's go to what? Let's have an illustration. Do we have an illustration there? From the above example, there is a statement that says no. No, we have an example. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest of 12%? Are you there? Have you seen that example? And finding future value of an annuity. Oh, that's due. Sorry. What is the value of 100,000 investment annually at the beginning? That's an annuity due. We are coming to that. I want us to have an illustration on the illustration on future value of an annuity. Okay, let's say from the above example, there is a part that is missing here. There is a part that is missing, but all in all, let's just write an example there. Just write something. Just write an example, an illustration. Say an investor intends to invest. An investor intends to invest shilling 60,000 at the end of each year for 4 years. An investor intends to invest shilling 60,000 at the end of each year for 4 years. At the end of each year for 4 years. Full stop and say, the investment will earn interest. The investment will earn interest at a rate of 20%. The investment will earn interest at a rate of 20%, compounded annually. The investment will earn interest at a rate of 20%, compounded annually. Compounded annually. Full stop. Determine the future value. Determine the future value of the investment. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. After 4 years. Now, future value of the investment. Now we start. This is how you should be approaching these questions. You first analyze the question. For example, here we are saying amount to invest is 60,000 at the end of each year. So annuity. We say annuity. Shillings 60,000. Annuity shilling 60,000 at the end of each year for 4 years. Period is 4 years. 4 years. Then the investment will earn interest at a rate of 20%. So 20% per annum. So we want the value of the investment after 4 years. So future value of annuity is equals to the annuity times 1 plus r power n minus 1 over r. So here you say 60,000 times 1 plus 0.2 power 4 power 4 minus 1 over 0.2. So get the value of the investment after 4 years. Then I show you another way of doing it. Get the answer, get the answer. Get the answer. Three 322,080. 322,080. Another person. 322,080. Another person. Alice, okay, that's fine. Now, there is another way of doing this question. So this is now, you say period, period, 1, 2, 3, 4. Annuity or amount. Remember, this person is investing 60,000 at the end. Yeah, at the end of each period. 60. 60. 60. 60. At the end of each period, this person is investing 60. So here you say 1 plus R power n. If we want to treat each amount as a lump sum, then here we will have future value. Future value. So here we will have 1 plus R. 1 plus R. This is 0.2. 0.2. 1 plus 0.2. 1 plus 0.2. 1 plus 0.2. 0.2. 1 plus 0.2. So before that, we know we've not put n. That is what I want to illustrate here. That is what I want to illustrate here. So we are 0. We always start at 0. 0 means now 1, 2, 3, 4. We're talking about 4 years, which is 1, 2, 3, 4. So here we have at the end. We are investing at the end. So at the end of the first year, 0, 60, 60, 60, 60. I want us to put n. So this 60 that you've invested at the end of year 1, how many times will it earn interest? The 60 that you invested at the end of year 1, how many times will it have earned interest at the end of year 4? It is here. 1, 2, 3. We have invested 60 here, so it will earn a return here, a return here, and a return here. So you say power 3. That is power 3. Then the other 60 at the end of year 2 here, it will earn interest here and here. So you say power 2. The 60 that you invest at the end of year 3, it will earn interest once. So you say power 1. And the last one, the 60 that you are investing at the end of year 4, it will have earned no return. So you say power 0. So multiply and get the total. If you multiply and get the total, we should be getting the same answer as this. We should be getting the same answer as this. So the reason why I just want you to get the concept here of power what, power what, power what. So 103,680 must be the first one. 103,680. 103,680. 86,400. 72,000. and 60,000. So get the total. Get the total. Three 088. Yeah. So almost the same as what we have here, just because of rounding off, that's where there are differences. So is that okay? Let's proceed. Let's do the next one, then we go for a break. The other one is future value of an annuity due. Future value of an annuity due. Let's wrap this. Future value of an annuity due. Now, what we have talked about here, it is an annuity that occurs at the end of the period. So here we had 60. If an annuity occurs at the end of the period, like in this case, that is what we've done in part B. But now we have what we call okay, fine, Alice, 080. Okay, fine. So future value of an annuity, this is when the amount is invested or paid at the beginning of the year, at the beginning of the year. For example, if our 60 here, 0, 1, 2, 3, 4. If the investment is done at the beginning of the year, for example, here 60, 60, 60, 60, 60, we call it 1, 2, 3, 4. This is not there. We call it an annuity due. So an annuity due is an amount that is invested or paid at the beginning of the period. And this will change because now, like here we had said this is power 3 because we counted here 1, 2, and 3. But if it's an annuity due, we will now have 1, 2, 3, 4 because we are going up to the end of year 4. Because we are going up to the end of year 4. So the amount that we invested at the beginning of year 1 here will earn interest 4 times. 1, 2, 3, 4. The amount that you invested at the end of year 1 will earn interest 1, 2, 3. This will earn 1, 2, and this will earn 1. So the entire thing will change there. But now, how about when we are using the formula? When we are using the formula, this is how we get the future value of an annuity due. So here we say future value of annuity due is equals to annuity times 1 plus r power n minus 1 over r. Then we add another factor here, 1 plus r. 1 plus r. 1 plus r. One plus r power n minus 1 over r times 1 plus r. So this is now what caters for the element of investing at the beginning of the period. So you can write that. And then we have an illustration. So back to the handout, there is an illustration. Finding value of an annuity due. We have an illustration for that. If you can check in the handout, they are saying, assuming the above example, the investment is made at the beginning of the year rather than at the end. So example, what is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest rate of 12%? So let's do that. So we're saying, what is the value of shillings 100,000? So annuity, the annuity is 100,000. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years? The period is 5 years. Interest is 12% per annum, and it's at the beginning. So future value of annuity due is equals to the annuity. And you need to be writing these formulas every now and then. Every time you're doing a question, kindly write the formula. Even if you know the formula, just write it. So annuity times 1 plus r power n minus 1 over r times 1 plus r. So annuity is 100,000 times 1 plus 0.12 power 5 minus 1 over 0.12, then times 1 plus 0.12. So get the value. Then you are going to use this method to see. So how much are you getting? 711,518.9. 711,518.9. Now, using this method, we will have this. We will have here 0 here. 1, 2, 3, 4, 5. And remember, the reason why we are starting at 0, you must count 12. Oh, someone else is getting 424, eh? 711, 424. Okay. Another person? A third person? Okay, let's continue as we wait. So, 513, 518, around that range. Now, so I'm saying we start at 0 because we must count 518. Eh? Okay, fine. Let's go with 518. We must count 12 months before we call it a year. So we are saying we are investing 100,000 at the beginning of each year. 100,000, 100,000, 100,000, 100,000. Remember, the end of year 1 is the beginning of year 2. So this 100,000 here we are investing at the beginning of year 2, which is the end of year 1. So we are saying this first 100,000 that was invested at the beginning of year 1, how many times will it earn interest in a period of 5 years? 1, 2, 3, 4, 5. So you say power 5. The other one is power 4, power 3, power 2, and power 1. The last one that we are investing at the beginning of year 5, it will also earn interest during year 5. So at the end of year 5, it will have earned once. That is why we are saying power 1. If you do the future value here, you're supposed to get almost the same answer as what you're getting here. So just check whether you're getting the same. On 76 to 34 point you can, okay, in this case you can round off. In this case you can round off to whole numbers. You can round off to whole numbers. In this case, there are situations whereby the decimal points will be required. So let's round off to whole numbers. The first one then should be 176 to 34, 157, 352, 157, 352, 144, 93, 144, 93, 125 for 40, 125 for 40, and 112,000. So get the sum. $711, $519. $711, $519. Now, the reason why we are doing these two methods, this is very short. This is like a shortcut. But we are doing this method so that you can get the concept. Because there are questions that will tell you that the amounts were invested at the beginning, the amounts were invested at the end of the period, this and this was happening. So this one is very important. Kindly get the concept. Then after the break, we will look at discounting techniques. Discounting techniques. After the break, discounting techniques. Discounting techniques. So let's have a break of like 5 minutes. And as we've said, discounting it is this determination of present value from a future amount. Determination of present value from a future amount is what we call discounting. Or rather, yeah, discounting. So we start with the first one. Present value of a lump sum. Present value of a lump sum. Present value of a lump sum is the first one. A lump sum still the same thing as we've said. An amount that is paid or received once is what we call a lump sum. So how do we get the present value of a lump sum? Present value just say PV, present value of a lump sum is equals to future value times 1 plus R power negative n. 1 plus R power negative n. So look at this factor now. Look at this factor now. Under compounding, we were saying power n, positive n, because we were moving forward. But now, under discounting, we are saying negative, because we are moving backwards. So get the difference. Present value for lump sum is equals to future value times 1 plus R power negative n. So where this is future value R is we said is the required rate of return. N is the number of periods, as usual, number of periods. Now this factor, the factor 1 plus R power negative n, the factor 1 plus R power negative n, we call it present value interest factor. This one, we call it present value interest factor. Present value interest factor. In this one, we can read from the tables. So present value interest factor, which is indicated as this present value interest factor, R percent power n. Present value interest factor, R% power n. So let me share with you the present value interest factor tables. The present value interest factor tables. Just check on your WhatsApp. Check on WhatsApp. Check in the WhatsApp group, I mean. I'm sharing the present value interest factors table, present value interest factor tables that we use for discounting. Present value interest factor tables that we use for discounting. I have shared. Once you receive it, kindly let me know. Once you receive it, kindly let me know. I want to show you how we read. Oh, okay, but that one we're going to do in an illustration. We're going to do in an illustration. So what do you need to add here? Nothing. Nothing. So when we are using tables, we say present value of a lump sum with tables. We say present value of a lump sum is equals to future value times present value interest factor R% power n. So this factor here, this is R, this is R, this is R% power n. Present value for lump sum is equal to future value times present value interest factor R% power. Because this factor should give us same figure as we have here. So let's have an example. I want to believe we have an example there. Let's go to discounting. Skip issues to do with quarterly discounting and semi-annually discounting. Let us go to discounting techniques. Discounting techniques, and we have an example there. We have an example there. Example says, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent? So we are saying, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount did you receive today to be indifferent using, that is, using present value? Okay, ignore that. Just ignore that. So here we have been given the future value. We've been given the future value. So here we're saying future value, it is the amount that you will receive in future. 172,800. Assume you are to receive 172,800 3 years from now, and 3 years. And the rate of interest is 20%. 20% per annum. So here we will say present value is equals to future value 1 plus R power negative n. Power negative n. So present value is equals to 172,800 times 1 plus 0.2 power negative 3 power negative 3. In short, how much are you supposed to invest today to earn to get 172,800 after 3 years at an interest rate of 20% per annum? Again, you say 100,000? 100,000, okay. 100,000. And or present value is equals to future value times present value interest factor R% power n. So this one you write 172,800 times present value interest factor 20% power 5. 20% power 5. So 172,800. So this factor now, we are going to read it from the tables. We are going to read that factor from the table that I've just shared. From the table that I've just shared, let's go there. From the table. Are you there? Kindly confirm. Confirm we're together. Oh, it's power 3, sorry. Power 3, power 3. Power 3. Thank you for your correction. I want to believe you have the table that I've shared. Now, in that table, in that paper, there are two tables. We have upper one and the lower one. And you can see some formulas written above there. So you can see the first one, they have written present value interest factor, present value of received at the end of periods, end periods. And we have the other one down there, present value of an annuity of 1 per period for n periods. So the upper table is for lump sums. The upper table is for lump sums. The lower table is for annuities. The lower table is for annuities. Now we are talking about lump sums. We are looking at the present value for lump sum. So you will go to, if you look at the upper row, in table 1, the upper row, we have percentages. The upper row, the first row, if I can say, we have percentages. And in the first column, we have periods. We have periods. So like, for example, we have periods upper. We have 1, 2, 3, 4. Then we have these percentages, 1%, 2%, 3%, all the way to 20%. We want 20%. So now, in our case, we are interested in 20% at period 3. 20% at period 3. So you go to period 3 and move up to 20%. You read the factor that is there. Just like we were doing in multiplication tables. Just like we were doing in multiplication tables, that is what you are doing. You go to the period, then go to the percentage. Or you go to the percentage, you drop up to the period that is required in the question. So read the factor that is there. At 20%, period 3. 20% at period 3, you're getting. Write the factor there, 0.5787. 5787. 0.5787. 0.5787. Then you multiply now. 0.5787. 5787. So then you multiply by this factor, but not factor, but amount. How much are you getting? 99.99.36. That is just like 100,000. You can see these factors are rounded off to 4 decimal places. So, but that is what we are supposed to do. That is what we are supposed to do. Any question? Any question? Okay, fine. If no question, we proceed. Present value No, yeah, present value of an annuity. Present value of an annuity. Present value of an annuity. We have seen what an annuity is. Present value of an annuity. Present value of an annuity. And the present value of an annuity, we say present value of annuity is equals to the annuity times 1 minus 1 plus r power negative n over r. So have that. Present value of an annuity is equals to the annuity times 1 minus 1 plus r power negative n over r. Then we are saying this factor, the factor 1 plus 1 minus 1 minus 1 plus r power negative n over r is called present value interest factor of an annuity r percent power n. Present value interest factor of an annuity r percent power n. Thus, present value of an annuity is equals to the annuity times present value interest factor annuity r percent power n. R percent power n. I can't find 0.5787. Catherine, let's go back to that table. Let's go back to that table. The upper table, 5787. We are using the upper table, Catherine. Are you there? Kindly confirm you're there, Catherine. Go to 20% under column, under row 1, the top row, go to 20%. After reaching 20%, go down to row 3. Not 3, but count 1, 2, 3. At 20%, you should go up to 0.5787. You'll see, yeah, that's how we read this thing. So for the annuities, this is how we, and you should be able to compute this. You should be able to use this. Remember, this formula here, this formula that you're seeing here, this one, it gives us the same figure as what we have in the tables, rounded off to 4 decimal places. You round this to 4 decimal places, you're supposed to be getting the same figure. So nothing different. So let's see an illustration. An illustration present value of an annuity. Yeah, we have an illustration and a present value of an annuity. An illustration and a present value of an annuity. And they're saying, assume that a project will give you shillings 1,000 at the end of each year for 4 years. What is the maximum amount would you be willing to pay For that project, if the required rate of return is 10%.
Do have basically a debit and a credit side. And we said on both the debit and the credit side, we record the date, the details, and also what the amount. Now, what we say is that when preparing the ledger account, we prepare them in accordance with the a rule of double entry, or basically the double entry concept or the jurity concept, which we said is a concept which states that for every transaction or each and every transaction will have to affect two ledger accounts. One of the ledger accounts will be debited, the other ledger account will be credited. And therefore, we say that once you're given a number of transactions, you're required to record them in the ledger account, you need to ask yourself two questions. So number one, you need to ask yourself which two ledger accounts will be affected by that transaction. You must identify the two ledger accounts to be affected. And then from there, we say you then ask yourself which account are you going to debit, which account are you going to credit. And basically, in this case, I showed you how to identify the account to be debited and basically the account to be what? To be credited. So having that, I want us to go straight to this illustration one, and basically we're going to move a little bit faster because we were able to go through the entire question. We identified the two ledger accounts to be affected, and also we identified the ledger account to be debited and the ledger account to be what? To be credited. So, but we first of all go through it. We see what you're told, and the question is, or basically we are told, prepare the relevant ledger account in the books of 𝐬𝐿 Enterprises to record the following transactions for the year which ended 2020. So basically, you're given the transaction from June 1st, basically to June 30th, to June 30th. And basically, from those particular transactions, what you're required to do is we prepare the relevant ledger account. So we're going to start with the first transaction where we are told, started a business with shillings 50,000 in the bank. So basically, we said, first of all, identify the two ledger account and then identify the ledger account to be debited, the ledger account to be what? To be credited. Now, we said that transaction basically will affect which account? First of all, it will affect capital account. And number two, it will affect what? The bank account, of which we say these two items. The capital is increasing and also the bank is what? Is increasing. And basically, remember, I gave you a small table here, which you can use in terms of knowing the account to be debited, the account to be credited, because we say these transactions will be affecting one of the items within the accounting equation, either asset, liabilities, or capital. We said a transaction can cause any of these items to increase or basically to do what? To reduce. We said an increase in assets is debit, whereas an increase in capital and liabilities is what? Is a credit. A decrease in assets is a credit. An increase, that is a decrease in liabilities and capital, is what? Is a debit. Is what? Is a debit. So therefore, we say because capital here is increasing, we credit, and also the amount of money in the business bank account is also what? Increasing. So this is an asset. So once the asset increases, we do what? We debit. So therefore, in that case, we need to open two ledger accounts there. The first ledger account we need to open is the bank account, and the other one is basically what? The other one is the capital account. The other one is the capital what? The other one is basically the capital account. The other one is the capital what? The capital account. The other one is the capital account. Yes, so let's open those two ledger accounts. So we start with the first one, which is the capital account. The capital account. Capital account. I hope you can be able to see up there. Yes, capital account. Capital account. So this account do not have so many transactions. So basically, it can be just a small account, And then from there, we have the bank account. The bank account. The bank account. So for the bank account, here we may have a number of transactions. So that account will be a little bit bigger compared to capital. So this is the debit side, whereas this is the credit what? This is the credit side. So then from have the bank account. You're not going to open a separate one, but basically we need to open what? We need to open the cash account. We need to open the cash account, the cash account, the cash account. So this will be the credit side, this will be the debit side. So we are saying we debit the cash account. We debit the cash account. The date is 12th of May of June 30th, 2020. So the other entry is the bank. I've said in the details column, we write the name of the other account being affected. So the amount is 1,000. So we debit that, we credit bank. So we have bank account here. So we have cash, an amount of how much? An amount of 1,000 like that. Yes. So we are done. So we go to 15th, we are told both fixtures paying by cash, sharing 600. So which two ledger accounts will be affected here? One is the cash. One is the cash. The other one is what? The other one is the fixtures. What will increase? What will reduce? One, fixtures were bought. Fixtures were bought. The fixtures, basically these are assets, and basically they will increase. So what do? We debit. Assets are increasing. As per our table here, we do what? We debit. Cash is reducing. So this is an asset still. When the asset increases, we do what? We credit. So do we have those two accounts? Yes. So we already have the fixtures account here. We already have the cash account here. So we need just to post that transaction. So in the cash, we credit here. The date is 15th of June 2020. So in the details column, we write fixtures, an amount of 600, and then we debit. We debit fixtures here, 15th June 2020, and basically it is cash, an amount of how much? An amount of 600. So then from there, we are told paid, we go to 19th, we are told paid motor cars limited by check shillings 8,000. So that will affect which two ledger accounts. One, the bank account will be affected because there was a payment through check. And then who was paid? The person who was paid, or the company which was paid, was this one, the motor cars limited. Actually, the full amount was paid, motor cars limited. So in this case, the amount of money in the bank is reducing because we have a payment. So we credit this. Automatically, this account will be debited. Remember, this is also a liability. Once you pay a creditor, the amount of money you owe to that creditor reduces. A creditor is a liability. Once a liability reduces, as per our table here, a liability reduces, we do what? We debit. So we debit this account, we credit bank. So you can see we already have those two accounts. So we credit bank here. The date is 19th of June 2020. So the other entry will be the account of motor cars, limited 8,000, and then we debit this account, 19th of June 2020. So the other entry is in bank account, an amount of how much? An amount of 8,000. We are done with that. So we move to the other transaction. We are told a loan of 1,000, that is a loan of 10,000 cash was received from 𝐻𝐿. So here we have a loan. So we are going to open an account called loan from 𝐻𝐿, or basically just a loan account. We can just refer to it as a loan account. Let's just refer to that as a loan account. And then this amount was received in cash. So our cash will increase because we have borrowed money. So once cash increases, we debit, and then we have borrowed money. Once we borrow money, that is a liability to our business. So the amount of loan has increased. So once a loan increases or a liability increases, we do what? We credit. So we credit to the loan account, we debit cash. So which account do we need to open here? We already have the cash account. Do we have the loan account? No. So we need to open the loan account. The loan account. We will just refer to that as the loan account. The loan account. Yes. So we credit this account. The date of the transaction. The date of the transaction is basically 21st of June 2020. So the other entry will be in cash. Basically an amount of 10,000. 10,000, and then we debit cash. Where do we have cash? We have cash account here. So this is the loan, 10,000. So 10,000 like that. Yes. So we are done. So 25th, paid 8,000 of the cash in hand into the bank account. So this will affect which two ledger accounts. The two ledger accounts will be affected here. One will be what? Will be the cash account, and number two, the bank. Because basically what happened is that the amount of cash in hand was taken and deposited into the bank. So the amount of money in the bank will increase. And because this is an asset, once the asset increases, we do what? We debit. The amount of cash in hand reduces. This is an asset. Once the asset reduces, we do what? We credit. So we will credit the cash account. We debit the bank account. So where do we have the cash account? We have it here. We credit it on 25th of June 2020. The other entry will be in the bank account, an amount of how much? 8,000. So then we debit bank account here, 25th June 2020. So the other entry is in cash account, 8,000. 8,000. So finally, we are told fixtures, both fixtures paying by check 3,000. So the two accounts to be affected here is the fixtures. And I hope there is no transaction as skipped there. I hope there is none. Yes. So fixtures, and basically they were paid for by check. So the amount of money in the bank reduces, we credit. Fixtures is an asset. This one increases. We do what? We debit. So we debit fixtures. We credit bank. We credit what? We credit bank. We credit a bank. We credit bank. So therefore, we debit. We credit bank here. So the date is that year of June 2020. So the other entry is in fixtures account. An amount of how much? 3,000. 3,000. And then we do what? We debit the fixtures here. So that here. And then the other entry is in bank account. 3,000. So we are done. We are done with recording those transactions. We are done with recording those what? Transactions. So if you're together up to that point, I want to show you how to balance this ledger account. Maybe you can just confirm whether you're together up to that point so that we proceed to balance this ledger account. Are we together up to that point, Eroto? I want us to move and basically we balance this ledger account. 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 Yes, a question, Eroto? Or you want to copy this? Yes. Okay. Anyone else who is copying the question? Anybody else copying the question? Anybody else copying the question? Other than Eroto? Okay, so Eroto, then I give you how many minutes? 2. Okay, so once you're done, let me know. Once you're done, let me know. Yes, I hope now you're done. I hope you're done now. I hope you're done. I hope you're done now. Okay, sawa. So basically, let me show you how to balance the ledger account. But basically, the concept which you use in balancing the ledger account is the same concept you are using in balancing the cash book. I hope you can remember the concept. So what were we doing when balancing the cash book? We were getting the total on the debit side, the total on the credit side, and basically here in the total, where we record the totals, we were recording the amount, the amount which was higher than the other. So for example, in this ledger account, the loan, what is the total on the debit? The total on the debit is 0 because we don't have any amount there. What about the total on the credit? It is 10,000. So in our totals here, we will record the amount which is more than the other. So which is basically 10,000. So we record it on both sides. So if you add this, it will give us 10. If we add this, it will give us what? 0. It will give us what? 0. So therefore, the difference between 0 and 10,000, we record it here. And basically, we refer to that as what? The balance carried down. The balance carried what? Down. The balance carried down. The balance carried down. The balance carried down. Can you see what you're doing? Sorry for that small interruption. Sorry for that small interruption. So basically, in this case, I'm saying the concept of balancing this ledger account is the same concept we are using in balancing the cash book. And I hope you have seen what I've done here. We get the total on the debit side, which is basically 0. The total on the credit side, which basically was 10. Out of the two totals you get, you pick the one which is bigger than the other one. So, and you record it in our totals here. So, let me repeat this one, or basically balance this one so that you understand what you have done. Then there is something else I'll still be able to show you. So what is the total on the credit? The total on the credit is 86. What about the total on the debit? The total on the debit is 11,000. So out of these totals, we pick the amount which is more than the other, which is basically 11,000. We record it here in our totals, 11,000. So basically, we know that if we add what we have on the debit, we will get 11. So, but if we add what we have on the credit, are we getting 11? No. So we are getting 86. So what is the difference between 86, 8,600, and 11,000? And 11,000. It is basically what? What are you getting here? Are you getting this one, Betty? Are you getting 24, Maria? Eroto? Yes. So that's basically how we balance the ledger account. But after balancing this particular ledger account, this one I hope you can see, just like what we are doing in case of cash book, we refer to that as balance carried down. BAL carried down. BAL C/D. That is balance carried down in full. So now after doing that, you must also have something called the balance brought down. Are we together? And I want you to be very keen here. So once you have the balance carried down here, you need to bring down that particular balance. So you bring it on the direct opposite side and basically record it below our totals. Can you see where I've recorded that? And be able to explain why we need to do this. So we bring down that balance on the direct opposite side. Don't record it above the totals, below the totals. Those are the two rules. You bring it down on the direct opposite side and also below our totals. Those two rules are very important. The same case, for example, this one. We bring it down on the direct opposite side. It will be on this side and also below our totals there. And also our totals. This will be balance brought down, 10,000. I want us to do the same for this other ledger account here. This ledger account. So the total here on the credit side is 8,000. The total on the debit side is 8,000. So you can see these amounts are equal. So it basically means that here we will have 8,000, 8,000. So this will give us 8,000. This will give us 8,000. So basically what that means is that account do not have any balance. No balance in that account. No balance in that account. Is that okay, Roto? Charles is still here. Charles, are you still here? Charles Akwapa Amadi Potea. Charles, I can see you. Yes. Charles, I hope that is very much clear. Yes. Maria, is that very much clear? Mary? Is that clear, Yusuf? If it is clear, say yes, because I want us now we finalize on this other ledger account. Okay. So we come to the capital account, we do the same. So the capital account, the total here is 50, the total here is 0. So in our totals here, we will record 50,000 on both the debit and the credit side. If we add this, it will give us 50. If we add here, we have 0. So we have a balance carried down here of 50,000. So we bring it down on the direct opposite side. So which will be on this side, that is on the credit side. So we do the same here to the bank account. So for the bank account, we can get the total on the debit, which basically will be 58,000. What about the total on the credit side? The total on the credit side is 13, 21, 21, 20 what? 24,000. 24,000. Maybe you can just confirm. That will be 20, 21, 24. That is correct. So the amount which is more is 58,000. We record it on both sides. 58,000. This will give us 58,000. This is giving us 24. What is the difference? The difference is 34. So this will be balance carried down. So we bring it on the direct opposite side. We bring it down on the direct opposite side and below our totals here. That basically will be balance brought down, 34,000. That is 34,000. 34,000. We do the same here. The total 20,000. The total on this side is 0. So the amount which we record here is 20,000. 20,000 like that. So we have balance carried down 20,000. So we bring it down on the direct opposite side and also below our totals. Balance brought down. Balance brought down. How much? 20,000. So we do the same to this other account here. This total will give us 76,000. 7,600, sorry. 7,600. So, and the total on the credit is 0. So here we will have 76. We have balance carried down 76, we bring it down on the direct opposite side. So we will have balance brought down of 76. And finally, this account, 4,000 on that side, 0 on this side. Yes. Is there a question? So someone is saying joint rates. So no need to worry, because I want us to do another question here. Sasa, no need to worry. If you joint rates, we are doing another question immediately after this. Immediately after this. And who is using the name of iPhone? Nani huyo anatumia jina iPhone? This is who? This is what is the name of my student here? Oh, Betty. Betty. Oh, so Betty, no need to worry. No need to worry, Betty. We are doing another question. But basically, I'm saying the reason why that is the rule basically when balancing a ledger account. So if your balance carry down is on this side, Betty, if it is on this side, the balance carry down, the rule is that the reason why we refer to it as carry down, at the start of the following month, you must bring it down. How do you bring it down? You bring it down on the direct opposite side. That is the first rule. On the direct opposite side, if carry down is on this side, brought down should be on the credit side. And also number 2, the other rule, this brought down has to be below our totals. Can you see that? Below our totals. Don't write it here. Bet here. Don't write it here. Sasa, it has to be on the direct opposite side and below our totals. I hope you can see that is what we are doing in all the ledger accounts. But no need to worry. Once by the time we are finishing the second question, you should understand this concept very well. Sasa, Betty, is that okay? If that is okay, we move now. I want us to finish on this, and then we do another one. Okay. So this balance, therefore, we bring it down. It will be on the direct opposite side and also below our totals like that. Below our totals like what? Like that. So that's basically how we balance the ledger account. Now, why do we balance the ledger accounts? So basically, we balance this particular ledger account so that now we can be able to prepare the financial statement. Usually, the ledger accounts are basically balanced, usually at the end of the year. So the reason why you balance the ledger account is for you to be able to prepare financial statement. But if you can be able to remember from our accounting cycle, we said before you prepare the financial statement, we must first of all come up with something called a trial balance. We must first of all prepare something called what? A trial balance. I want to show you how to prepare trial balance, but even before we prepare trial balance, what is a trial balance first of all? A trial balance basically we say in very simple terms, this is the list of all remaining balances after balancing the ledger accounts. After balancing the ledger what? After balancing the ledger account is the list of all balances, remaining after balancing the ledger account. And basically the balances which you transfer to the ledger to the trial balance, the balances which you transfer to the trial balance are these balances brought down. That's why I've said after balancing this, you must have brought down. We must have the balance brought down. So therefore, all balances which remains after balancing the ledger account. How do we prepare a trial balance? A trial balance basically do have 3 columns. The first column is called the details column. The other column is called the debit column, abbreviated by DR. And the last column is called the credit column, abbreviated by what? By capital CR. Now, how do we record these balances here? For example, we pick this balance from this account, and we say from the loan account, we just write the name of the account, the loan. We bring the balance brought down here. So the balance brought down, you must check, is it a debit or a credit balance? For example, this balance, take into account it is on the credit side, you record it here on the credit column. We say these are credit what? Balance. And you can see what I've posted here. What I've brought here is not carried down, but basically brought down. But basically brought what? Down. What about, for example, this cash account? Come and write, you say from cash account, just write the name of the account cash. Which balance or how much balance do we have? We have a balance of 24. This balance, is it a debit? Is it a credit? It is a debit. So if it's a debit, record it there. Record it what? There. Sasa? Yes. So what I want us to do now, I want us from this question, we basically extract a trial balance. And basically by the end of the day, once you have recorded those balances here, you need to add the total on the debit column here, the total on the credit, and these two balances should be the same. Should be the same. So if those balances are not the same, we say your trial balance are not balanced. And the reason why your trial balance will not balance is because you have made some error. So because once you have recorded now the transactions using the concept of double entry, your trial balance should automatically balance. So therefore, we want us to prepare the trial balance of this business called 𝐿𝐻 Enterprises. This, remember, is the trial balance. The trial balance is that 30th or basically 31st, I think should be 30th of June 2020. So remember, you say that this trial balance basically do have how many columns? 3. The details column, the debit column, and the credit column. So this is the debit, this is the credit, this is the details column. The details what? A column, the details column. So let's start by posting this particular balance here, the loan account. So we write the name of the account, loan. So then we bring this balance, brought down, not carried down, brought down, which is basically on the credit side. We record it on the credit column there. Then the cash. So we have a debit, a balance of 24, which is basically brought down on the debit. So what about this account? Do we have any balance? No, no balance here. So then from there, we can just pick the capital. So capital, we have this balance, which is a credit of 50,000. So we have bank. We write bank there. So bank, you can see we have a debit balance of 34,000. So motor van, we just write the name of the account here, motor van. So you can see we have a balance brought down, which is a debit balance of 20. So fixtures, we have a debit balance of 76. And finally, we have Office Masters Limited. Office Masters Limited. And basically, is a credit balance of 4,000. Or forward 4,000 like that. And basically, I hope you can see we are done. We are done. So basically, what now we need to do is we get now the totals. We get the totals. So whatever you have on the debit should actually be the same as what we have on the credit. So what do we have here? This is 60,000. This is 4,000. That would be 64,000. What about on the debit side? And we add what we have on the debit. On the debit, we have 2,400 plus 34,000 plus 20,000 plus 76. What are you getting here? What are you getting on the debit? What are you getting? Betty, Yusuf, Mary, what are you getting? Betty, I think we have 2 Betty here. What are you getting on the debit? On the debit column here. Charles, are you getting 64,000? Are you getting 64,000? That is what I'm getting, 64,000. That is what I'm getting. Huh? They're asking about what? Charles, what do we have motorcar? Are you referring to this account? Charles, this account, you can see it has no balance. This account has no balance. This account, you referring to this out, Charles? Charles, are you referring to this? No. You can see, do we have any balance here? So if an account do not have a balance, don't record it here. So remember, you have said that this is a list of all balances. So if there is no balance in an account, you don't have to record that account there. So we only record those accounts which do have what balances there. Is that okay, Charles? Is that okay? Okay, sawa. So what I want us to do, I want us to take a short break of just 8 minutes. We come back at 7:10, and basically we look on the other question. Sasa, I want us to wind up with this area today. So let's come back at 7:10. So make sure you have the other illustration, which is in the same handout. Yes, so if you're back, we can proceed, confirm whether you're back, we continue. Are you back? I want us to continue. Are you back? Are you back, Betty? Are you back, Maria? Are you back, Charles? Eroto, are you back? If yes, please confirm.